Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss how inflation and rates are impacting growth stocks, with the CPI data this morning adding to those concerns. Phil, we can see on the first couple of charts here how stocks are responding to a rise in rates this week.
Yeah, I mean, it's been a pretty negative week for stocks, and it's surprising, really, because we had a pretty strong Thursday, Friday for stocks as well. That was on the back of the jobs data, which was actually pretty poor, if you remember. And a lot of the people in the market said, well, if the jobs data is poor, that means we're going to have rates lower for longer, which means valuation should go up. But I think the more we look at all of the other data points that are coming out, the more people are becoming skeptical of that jobs data. There's a lot of information out there that shows there's heaps of jobs openings. There's a lot of people trying to get back into like the leisure sector. There's a lot of difficulty finding workers, and actually it's starting to translate into some wage pressures. So I think the supporting data shows that there's probably still inflation out there. And as you said, this morning's data basically proved it.
And steep prices in food and metal prices have stirred concerns of a new commodity super cycle. Tell us more about that.
Yeah, I think people are still skeptical about it because if you look at a lot of the commodities, whether you're looking at grains and soft commodities or you're looking at a lot of the metals that go into the manufacturing sector, they've been on a tear. And some of them have been on a multi-year tear. Some of them have been bouncing since the bottom of the coronavirus sell-off as manufacturing has recovered. But commodities are getting more expensive. I mean, oil's the one that we see every day, but a lot of the metals are up as well. Corn and a lot of grains are up as well. It just speaks really to the amount of stimulus in the system and the growth in the manufacturing sector. But if a commodity super cycle happens, that's a bigger deal. That's when the demand sort of outstrips supply. You can't find mines in a hurry, and so you end up with a bigger rally that persists for longer in commodities and actually ends up filtering through to production prices and goods prices as inflation as well. So I think the jury is still out on whether we do have a commodity super cycle. But if you look historically, you do tend to see like multi-year periods where commodities are expensive, and then multi-year periods where they become cheaper and sort of plentiful supply as well.
And Phil, we can see in the last chart here, it's all going to come down to the consumer bearing the brunt of this, and they're expecting those prices to go higher. And I'm sure you've noticed this as well. It's quite clear in the bills that we can see coming in right now.
It really feels like it, doesn't it? And so the data before we saw this morning's information was showing the consumer was, looking at their groceries, looking at their house prices, looking at their secondhand car prices, looking at lots of different things. If they're trying to do extensions to their home and adding a home office, all way more expensive than they were a year ago. And the data we got this morning pretty much confirms that. I mean, the data this morning is interesting because it was 4+% of inflation, but it's coming off the lowest base possible. So 12 months ago, we were in the depths of coronavirus, deflationary pressures because no one was buying anything, and companies that wanted to actually have any revenues had to discount things. So we've kind of, this is a data point blip, and a lot of people think that's why it will be transient, especially the Fed thinks it'll be transient. We'll have 2 or 3 months of this, and then all of a sudden we'll be back to the old-fashioned normal prices, and it'll go away. The risk is, though, if it starts to filter through not just into input prices, but into wage price inflation and then product price inflation, we could have a cycle, and that's going to be harder to break, especially if the Fed is willing to be really patient. With rate rises, we could actually see the Fed a bit behind the curve.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.